My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After a terrific day where the Dow surged 182 points, S&P gained 0.27%, Nasdaq advanced 0.28%. You need to know that this rally's not phony. It is real. It's definite. But, and this is a big but, you know what? I think it's time that we just shade things. I think we should take a little off the table. Why do I say that? It's not just because when I walk around downtown Manhattan, I'm hearing more, hey, make me some money, Cramer catcalls, than I am hearing booyah, or I love the show, shout-outs. It's not just the fact that even the losers are turning into winners, which typically means you're late to the party. No. It's because all the issues that have dogged the market suddenly seem to have gone away. So I'm feeling like we got a kind of Pangloss moment here. Yeah, Pangloss. That means, frankly, it means that we're in a position. Well, let me just say the Pangloss sellers, that's not what I'm talking about. That's that great vineyard in Sonoma. I like that. We're not talking about delicious Cabernet here. We're talking about Voltaire's Pangloss. All is for the best isn't the best of all possible worlds, Pangloss. Whenever we start getting that vibe, it makes me want to sell something. Because the best of all possible worlds never lasts. First, though, let's talk about what's going on right now, because there are some good reasons people are so optimistic. Exhibit A, the 10-year Treasury. For months, the bears told us that we were headed for a recession because bond yields were plummeting. They argued that if interest rates kept falling, we were going to start importing negative rates from Europe, which was supposed to be really bad. They claimed that the inverted yield curve, where our long rates had fallen below our short rates, meant that a serious slowdown was inevitable, if not a recession, and you got to stop buying things and stop expanding, and you got to be more negative. Kind of a bit of a chicken and egg story. As our bond yields went down, thanks to Europe, investors panicked because plummeting bond yields are a sign of economic weakness, which just caused more bond buying. It's a flight to safety, and that pushed yields even lower. But a funny thing happened on the way to the inverted yield curve. The inverted yield curve induced recession, I should say. Turns out the Fed chief Jay Powell follows the financial markets too. Who knew? He saw that things were going awry. He knew that a yield curve that's inverted can only really be cured by two ways, okay? And that is, one, strong loan demand, which would raise the longer rates, or a rate cut. So he gave us a rate cut. By the way, that's why I never panicked about the yield curve, because I knew the Fed, after doing the wrong thing, was going to start doing things right. That's the way it works. Even worked that way a little too late there in the 2008 period. They know nothing! Now, why wasn't that self-evident to the pessimists? I've got some theories. First, a lot of these naysayers hate Trump to the point where it messes with their judgment. We saw the same thing from the other side of the ideological spectrum under Obama. They didn't want to say anything against the bearish narrative for fear it would be viewed as a tacit endorsement of the president. Think about that. Second, many negative money managers needed the market to go down in order to be able to beat their benchmarks. They bet against the market or were underinvested. So they were eager to cheer for a thesis that predicted a recession. So their caution would go over better with their investors. Third, the only legitimate reason in my eyes, Jay Powell used some silly words to talk about rate cuts, saying something about some sort of mid-course adjustment. Boy, everyone keyed on that. It's meaningless. It's parsing that's meaningless. Powell raised interest rates too far, too fast last year. Now he has to undo the mistake, but he can't just come out and admit it. I mean, the guy would have to be a real masochist to speak candidly about this stuff. So he ended up throwing a lot of people off the scent with that mid-course thing. His real plan was to ensure we don't end up like Germany with a stagnating economy and an inverted yield curve. Not on his watch. Funny thing about Jay. He got us right where he wants us. He had all these people claiming that he was done cutting rates. But all along, he was simply following the footsteps of his brilliant predecessor, Janet Yellen. He let the data and the homework tell the story. Don't pay attention to the overanalyzers. He's not done cutting until the data says he's done cutting. Now, we no longer have an inverted yield curve. Remember that? Oh, we were so worried. They were hand-wringing. The recession fears have been taken off the table. Problem solved. In truth, it never would have been a problem in the first place if people hadn't panicked about it. That's one reason the averages have been so strong. Nobody worries about a recession anymore. And that's why you see all these big cyclical stocks going up and the secular growers selling off. Second piece of the Panglossian worldview, the belief that the trade talks will go smoothly. Just the other day, we heard that they were going badly. Remember that? They couldn't find a location or it was like delayed. Of course, it's entirely possible that something positive is going on, that the tariffs could be rolled back. I say that because China has finally followed through on one of its promises. They're cracking down on illegal fentanyl exports that are killing so many people in our country. It's the first sign that maybe the Communist Party means business. Rolling back the tariffs, though, let's see what else they agree to do before we get too giddy. I'm not happy. Well, let's just say I find the stories quizzical. At the end of the day, I don't like how everything suddenly seems so rosy just 48 hours after everything seems so horrible. I think some ill-advised statements being made. Next bit of complacency, earnings, specifically earnings in retail and tech. This morning, Ralph Lauren reported a fantastic number with excellent growth, sharply better than expected. It's been ages since we've heard that a supplier to retail, especially a mall retailer, is doing well. And, of course, they also own freestanding stores. Now, forget that much of the strength here came from pulling merchandise from poorly performing malls. When you see the end of the inverted yield curve, you want to buy stocks that do well in a healthy economy, and apparel fits the bill. RL even here does. You know what, though? You know what I really like? Columbia Sportswear, COLM. It had the misfortune of reporting back when everyone was still worried about a recession. If it had reported today, the stock would have been flying too, and Mr. Boyle was on. You know he told a great story. But let's be careful here. See, because the pin action from Ralph Lauren spurred a major rally in retail. It was also helped last night by Costco doing a little bit better than expected. And the problem is it's very unlikely that all these retailers are doing well. Time to trim, as anyone who owns the faltering Gap, which just reported a not-so-hot number and saw its CEO dispatched with, knows. I'm trying to keep you out of more gaps, not just the store. The fourth source of complacency, the endless run in the stocks of the banks. You know I've been a huge champion of the group. I think the financials represent incredible value. And the rebound in long-term interest rates will let them make more money. But can we just admit that the people buying these banks, let's just say they aren't exactly early? Sure, some of the larger banks could get business from a move into China if that Chinese let it happen. However, I doubt business has gotten that much better that fast. I think it's too tenuous given that we're still in the midst of a slowing economy. Final piece of the Pangloss puzzle, the possibility that the rollout of 5G wireless networks will drive all semiconductor cohort higher, not just the companies that benefit from 5G, which I will outline later in the show. No, all of them are going higher. And that's how we got Wall Street's reaction to the huge number Qualcomm reported, moving everything up that has anything to do with anything inside a cell phone, but also, most importantly, inside cars, inside buildings, inside data centers. Hey, come on, not all that's working. I mean, Qorvo was great, but people have extrapolated that to pretty much everything. They did it again with Qualcomm. I say dream on. There are plenty of great 5G plays. I have them, but don't go beyond them. Look, I'm not saying you should expect a big sell-off. I don't. In fact, many stocks like that of Disney act like champs. But the bottom line is that when you have a jailbreak of immense stock proportions like we're having right now, you need to remember that not everything will work out perfectly. So when the market starts behaving like we're in the best of all possible Panglossian worlds, it is time to ring the register, go out, maybe go buy a cashmere sweater. And that way you'll have more cash to work with the next time things go south, because we know, sadly, they always do. Let's go to Rose in New Jersey. Rose.
Hi, Jim.
What's up, Rose?
Well, I'd like to know what you think about Groupon's subscription program.
I was depressed by that Groupon number. I was depressed by it. I expected better. It was disappointing, and it's time to cut your losses. Sorry to be so bold, but that's what it is. I need Stephen in Pennsylvania, please, Stephen.
Yeah. Hi, Jim. How are you?
I am good. How about you?
I'm good. Question is Roku. A couple weeks ago, it was at 99.
Right.
Then it shot to 150. And last night, after the earnings was reported, it lost $20.
Well, I mean, the quarter, if you listen to the conference call, they basically threw cold water on the kind of rapid fire growth that they have. When management throws cold water on it, I'm not going to stand up and say that they're wrong. And that's what happened there. How about we go to Matt in New Jersey? Matt.
A great big stock market guru boo you to you, Jim.
Nice. Kind of a poet thing going there. What's going on?
Always great speaking with you. I'm a second-time caller, and I'm here with my son, Luca.
Luca.
Booyah, Jim.
Yo, booyah, Luca.
Okay, so sitting at the dinner table the other day, my son was talking about a stock that he was thinking of buying.
Okay.
So I'm going to let him tell you about the stock.
I am 10 years old. I have some money in savings and wanted to buy a stock. In June, this stock fell 21% due to declining same-store sales and flat earnings report. It has been in the house of pain ever since. Jim, I like the place, but do you like the stock Dave & Buster's?
This kid's got horse sense. What can I say? That's just good. And you nailed everything, including the fact of the same-store sales not being good. So I got to tell you, Maddie in New Jersey, here's what you're going to do. You're going to stay away from that one because even though long-term it might be okay, there's going to be a better time. And that time is going to occur after we see the next quarter because that last quarter was, all I can say, disappointing. And you know what? It's always hard for me to believe it could be disappointing because they got this thing. It goes down like this, and then you pick up stuff. And I once lost $28 in that, and I finally won. It was like I got something that was worth like 28 cents. That's a good business. What's the deal? All right, it's time to take something off the table, maybe a little. I don't expect to sell off. Nothing big, right? But not everything works out as perfectly as it looked like today or Mad Tonight. I've got something to say to the doubters of progress in the Chinese trade talks because there's an interesting twist that you're not talking about. You're not going to want to miss it. Then I spent plenty of time focused on stocks that could benefit from a 5G build-out. Tonight, I'm eyeing one player that's already reaping the rewards that started the revolution itself. And can you cash in on your next run to the shopping center? I got a company that's got a 5% plus yield. Maybe it's the way to go. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.